Hello everyone, welcome to the 160th episode of me learning how to trade in Forex. So in the last episode, we finished off going through finding the right product with the last few assets, which are exchange traded products, turbo warrants, covered warrants, constant leverage certificates, and then we went through the choosing the right product combination to suit your risk profile and your time horizons, and also considering leverage and how well you understand each product to aid in your decision making. Remember though, you can have multiple financial goals you want to achieve, so therefore you could follow a multi-product strategy, which is going to be covered in this episode. And then we went through the lesson summary. So now we're on to using a multi-product strategy, which we already gotten started with. So yeah, let's get started then. So using a multi-product strategy, one of the beauties of the stock market is that you can engage it with however you choose. As we mentioned previously, you may prefer to use different products simultaneously to help you meet your financial goals. In this lesson, we outline some of the common multi-product strategies used by traders and investors. You can select elements from one or more of the methods we've included, or create one that's tailored to your needs. However, before we jump into some examples, let's look at why you might want to use a multi-product strategy. So benefits of a multi-product strategy. Putting all your investment into one stock or account can be risky. So, putting all your investments into one stock or account can be risky. The same is true for trading on only one market. The value might increase, meaning you turn a profit, but if your position doesn't perform well, you may end up with a loss. Firstly, a multi-product strategy can help you better achieve your aims. Multi-product strategy can help you better achieve your aims. Remember, you will likely have several different goals like saving for retirement or getting together capital needed for a deposit on your new home. A diverse multi-product strategy could help you support these and provide you with the money that you need when you need it. A diverse multi-product strategy could help you support your several different financial goals and provide you with the money that you need when you need it. Provide you with the money that you need when you need it. With this wide-ranging approach, you could also use hedging to help protect your portfolio from significant losses. So you could also use hedging to protect your portfolio from significant losses. Did you know hedging is a strategy used by both traders and investors in slightly different ways? It attempts to limit the risk in your portfolio and minimize the impact of your losses. Say you've invested in tech stocks hoping for long-term growth and profits. However, you see a recent news announcement that may negatively affect the market prices. You could use derivatives to open a short position that would benefit from the fall. If the market price does indeed decrease, the derivatives would increase in value. But then if the market price doesn't decrease and increases instead, the derivatives would decrease in value, which would eat up some of your profits. So works both ways. Common multi-product strategy structures. When you're building your portfolio, you can follow the structure of a pyramid. So when building your portfolio, you can follow the structure of a pyramid. At the bottom, you may choose to include various investment products as they're typically lower risk. So at the bottom of the pyramid, you may choose to include various investment products as they're typically low risk. As your structure narrows towards the middle, you could purchase individual shares, slowly increasing your liability. Towards the middle of the pyramid, you may choose to purchase individual shares, which slowly increases your risk level. At the top of the pyramid, you might include leverage trading. This is generally considered the highest risk. You might choose to do leveraged trading, which is considered the highest risk. If your leveraged positions experience a downturn, you could only be losing the smallest piece of your overall portfolio, while the rest might be safe and can continue growing over time. So if your leveraged positions experience a downturn, you could only lose the smallest piece of your overall portfolio, while the rest might be safe and continue growing over time. While the rest of the portfolio is safe and can continue to grow over time. The key to a successful pyramid is to build on a solid financial foundation and limit exposure to more risky investments at the top. So the key to a successful is to build a solid financial foundation at the bottom and limit exposure to risk to more risky investments at the top. Adopting this approach can give you power over exactly how much risk you're willing to take on and how much time you want to spend managing your portfolio. So this allows you to control exactly how much risk you're willing to take on and how much time you want to spend managing your portfolio. In the sections below, we're going to illustrate different versions of the pyramid you might adopt, starting from the bottom. So, Pyramid 1, combining different investment products. This low-risk structure for a portfolio might be classified as a long-term strategy. You might invest your capital in bonds or a savings account, or choose ETFs and manage portfolios comprised of stocks and perhaps some bonds for stability. Combining different investment products, ETFs, manage portfolios. So pyramid examples. Pyramid 1, low risk structure for long-term. Low risk structure for long-term strategy. You know what? 50. No, I can't even go 50. Never mind. Might want to invest your capital in bonds or savings accounts, or choose ETFs and manage portfolio comprised of stocks and perhaps some bonds for stability, or choose exchange traded funds and managed portfolios for comprised of stocks, some bonds for stability. The shape here may resemble a rectangle more than a pyramid, but it's still a multi-stock and multi-asset strategy. Having numerous stocks mixed with some bonds reduces investment risk and creates a strategy that's relatively simple to manage. While it can take more time, this approach has the potential to produce returns ahead of inflation and create real wealth. Having numerous stocks mixed with some bonds reduces investment risk and creates a strategy that's relatively simple to manage. While it can take more time, this approach has the potential to produce returns ahead of inflation and create real wealth. Well, it can take more time. This strategy has the potential to produce returns ahead of inflation. Pyramid 2. In this instance, the pyramid might have a base of collective investments with individual shares making up the top part. You can use multiple investment products with different levels of risk. However, you're still able to avoid the increased volatility of leverage trading. Have a base of collective investments with individual shares making up the top part. So this is adding on to what we did for Pyramid 1 by adding on to growth stocks and value stocks. So, you can use multiple investment products with different levels of risk, however you're still able to avoid the increased volatility of leverage trading. So, you can use multiple investment products with different levels of risk. However, it's still able to avoid the increased volatility of leverage trading. Did you know, among the different categories in which we could classify the shares of listed companies, there are two that many investors consider when designing their investment portfolios: growth stocks and value stocks. Your investment style and goals may dictate which suits you best. Growth stocks belong to companies that investors believe will deliver above average returns. So, growth stocks belong to companies that investors believe will deliver above average returns. These tend to be volatile, so you're more likely to earn a profit from the quick price changes than from dividends. These tend to be volatile, so you're more likely to earn a profit from the quick price changes than from dividends. However, this could make investing in growth stocks riskier. If your expectations for fast growth are misplaced, you may make a loss. So, however, this could make growth stocks riskier as the fast growth might not happen and you make a loss instead. On the other hand, value stocks, so refer to those from companies that are currently considered undervalued by other investors. Belong to companies that are currently undervalued, that are currently considered undervalued by the investors, by other investors. Here you're hoping to purchase stocks that have a demonstrated history of good profit. You're hoping to purchase stocks that have demonstrated history of good profit. That have a demonstrated history of good profit. That are currently considered undervalued by other investors. Considered undervalued. So they should be worth more, basically. Typically these remain steadier. So these can't spell. These stocks typically are less volatile, with the market price rising slowly and a greater likelihood of receiving dividends. With the market price rising slowly and greater chance of receiving dividends. As with any investment, there's no promise of future profits. Remember that there's no promise of future profits. Value stocks could be correctly priced by the market, and so purchasing them might not be the bargain you assumed. Correctly priced by the market, so purchasing them might not be the bargain you assumed. So value stocks could be correctly priced by the market, so purchasing them might not be the bargain you expected. Within the individual stocks part of the strategy, you can allocate funds to some dividend-paying value stocks in the middle and to growth stocks right at the top. Value stocks, growth stocks. Growth stocks at the top. But isn't growth stocks below the value stocks here though? So shouldn't these two switch? While they can add to returns, they may also add to your overall risk. You could split investments in several ways to form the pyramid, but remember, the bottom section should ideally have a larger percentage. The passive diversified base could form 60% and the rest can be split between individual stocks. You can allocate funds to some dividend paying stocks in the paying value stocks, and you can allocate funds to some growth stocks. While they can add to returns, they may also add to your overall risk. Remember that they can add to your overall risk. You could split investments in several ways to form the pyramid, but remember the bottom section should ideally have a large percentage. The passive diversified base could form 60% and the rest could be split between individual stocks. So you could split investments in several ways. To form the pyramid. However, the bottom section should ideally have the largest percentage. Pyramid 3, combining investments and trading products. Wait, this should be our last line. So, Pyramid 3. Combining investments and trading products. Adding on from the previous option, you may want to include a trading portfolio right at the top of your pyramid. So, adding a trading portfolio at the top of the pyramid. So, adding on from the previous option, you may want to include a trading portfolio right at the top of your pyramid. While this will add more risk, it's less likely to destabilize the structure because of its sturdy base. It also has the potential to add to your overall returns. So we've got options trading and other leveraged derivatives. The trading products used can further diversify your portfolio, plus they could be used to add some security if you choose a hedging approach. So the trading products could be used to add security, some security if you choose a hedging approach. Another way to ensure your portfolio can weather volatile markets is by using a derivative product to take a short position, like CFDs, ETFs, or ETPs or options. So contract for differences, exchange traded products or options. Let's see how using a put option would work. A derivative product can be used to a derivative product can be shorted to ensure your portfolio can weather volatile markets. Let's see how using a put option would work. So put option, remember, is shorting an option, right? I think the other one's called a call option, no? Put option. To sell a call option, yeah, so selling a call option means you're giving the buyer the right to buy. Selling a put option means you're giving the buyer the right to sell. Use put options if you think the market will fall, yep. So, let's see how using a put option would work. So if you anticipate that the market will fall, these will rise in value as the underlying asset depreciates, providing you with a potential profit to offset your losses. If your positions have a strike price that's lower than the current market price, of the underlying, they're known as out the money. If your positions have a strike price that's lower than the current market price of the underlying, they're known as out the money. The strike price is the level at which you can exercise the option. In the case of a put option, this means selling at that price. If your positions have a strike price, so the level at which you can exercise the option that's lower than the current market price of the underlying, they're known as out the money. The strike price is the level which you can exercise the option. In the case of a put option, this means selling at that price. When a put option is out the money, so when a put option is lower than the current market price of the underlying assets, it's likely to be cheaper because it doesn't have any intrinsic value yet. So commodity options gives you the right but not the obligation to trade an underlying asset at a specific price called a strike price before the option expires. Specific price before the option expires. If your position have a strike price, so has a specific price that's lower than the current market price of the underlying asset, they're known as out the money. The strike price is the level at which you can exercise the option. In the case of a put option, this means selling at the price. When a put option is out the money, it's likely to be cheaper because it doesn't have any intrinsic value yet. I don't really know what that means, to be honest. If your positions have a strike price, so if the specific price that you cannot exercise the option at is lower than the current market price of the underlying asset, it's likely to be cheaper because it doesn't have any intrinsic value yet. Okay. You could also choose to put options that are long dated, meaning you can hold them for longer. You can also choose to put options that are long dated. Long dated. Choose put options that are long because you can hold them for longer. Also, the expiry date is longer into the future. Let's see how that works. Say the FTSE 100 is trading at 9,500. For a put option to be out the money, you want the strike price to be lower than the index's current value. You're using this option as a method of insurance in case the markets move against you, so you want to exit position when it's 10 to 15% lower than its current level. Which of the following options would you buy? So calculator, 10 to 15% lower than its current level. So what's 10% of 9,500? 950. So 9,500 minus 950, 8,550, which is not on here. Let's try 15% then. 9500 times 0.15, 1425. So 9500 minus 1425, 8075. That is not on there as well. What's the question again? Say that the FTSE 100 trading at 9,000. Right, for a put option to be out the money, you want the strike price to be lower than the index's current value. Lower than the index's current value, so you want anything below 9,500. In case the markets move against you. So for a put option, so you're hoping the value will go down. So you're protecting yourself in case the market goes up, right? If you put option, so you're hoping the market will go down. So you're protecting yourself then if the market against the market going up. You want to exit position when it's 10 to 15% lower than its current level. 9597 put option out the money. You want the strike price to be lower than the index's current value. I don't really know, to be honest. I think it's one of the 8,000s because it's lower than 9,500. Let's go with this one. Okay, 10% 9,500. The current market price is 950. If you subtract 950 from the current market price, it will equal to 8,550. Yep. Of the possible solutions supplied, only A, 8,467 is more than 10% lower than the current market level. To confirm this, you can use the following calculation. 9,500 minus 8,467 is 1,033. If you then divide it out by the current market price and multiply the value by 100, you'll see that option A is 10.87% lower. Oh, right, okay. Oh, so it's not the exact numbers, but oh, right, so that one is lower than 8,550, so it's more than 10% lower than the current level, right? Whereas this one isn't, right? Okay, I see. So using options can be a complex strategy, but it might be worth considering as they can help you mitigate some of the risk. They can offer short-term protection if you're risk averse and worried about the market sell-off. They can offer short-term protection if you're risk averse and worried about market sell-off. So, short-term protection. I thought options was a long-term. No, using options, but they can offer short-term. So options can offer short-term protection. So derivative market. So here. Options can offer short-term protection. Can offer short-term protections as they can help you mitigate some of the risk. To mitigate some of the risk of volatile markets. Wait, if you anticipate the market will fall, these will rise in value as the underlying asset depreciates, providing you with potential profit to offset your losses. Nah, let's just delete because I don't really understand what I'm writing here, so no point writing it down if you don't understand what he's saying. What is going on? So So they can operate short if you're risk averse or worried about a market sell-off. In this strategy, you may keep the base made up of passive products and managed portfolios could remain higher than 50%. You can allocate 30 to 40% to shares, split to favour more of the value stocks, while your trading activity at the top will sit at 15% or less. So your base, your safe options are always the biggest chunk of your investment portfolio. Pyramid 4, a trading only strategy. So Pyramid 4, trading only strategy. Entering the markets using trading alone could be a risky option because the base of your pyramid might lack the stability you could get from long-term investments. However, you can still structure your pyramid to manage your overall risk. So entering the market alone from using trading could be because it lacks the stability. Trading pyramids lack the base stability, lack the base stability from the long-term investments. However, you can still structure your pyramid to manage your overall risk. So trading only strategy, individual stocks or ETPs, exchange traded products, other leveraged derivatives, so that's trading. Your base could include exchange traded products that can diversify your portfolio but with a lower level of leverage. Options with a limited downside might also work for you at the lower end of the risk pyramid. While they do use leverage, it's often lower and the downside is capped at your initial outlay. Just note that when you sell a put option, your losses are potentially limitless. Your base could include exchange trade that can diversify your portfolio. Base can include exchange traded products with a lower level of leverage. Options with a limited downside might also work for you at the lower end of the risk pyramid. While they do use leverage, it's often lower and the downside is capped to your initial outlay. Just note that when you sell a put option, your losses are potentially limitless. So note that when you sell a put option, your losses are potentially limitless. With a barrier option, you can limit your potential loss even more. You're able to set the level which expires, thus reducing risk. With this strategy, your base of leveraged ETPs would cover over 50% or cover between 50% and 75%. Right at the top, you could allocate 10% of your funds to fully leveraged individual assets. The remainder might include options which limit your downside risk. Okay, so Pyramid 5, using an options trading strategy. Using options trading. So another way to structure the trading part of your portfolio is by using vanilla and barrier options. Remember that call options increase in value when the underlying asset is rising, while put options increase as the underlying value falls. A blend of call and put options on different assets could reduce overall risk in your pyramid because you profit from both rising and falling markets. So using vanilla and barrier options. A blend of call and put options on different assets could reduce the overall risk because you would profit from both the rising and falling markets. To diversify your portfolio, so blend of profit from both rising and falling markets. In this instance, you're hoping that the profit from one might offset the losses from the other. Choosing uncorrelated assets can help you optimize this strategy. You're hoping that the profit from one might offset the losses from another. Choosing uncorrelated assets can help you optimize the strategy. Choose uncorrelated assets to optimize this strategy. If you're using options as a trading part of a diversified pyramid portfolio, they can offer insurance as detailed earlier in this lesson. Options as a trading part. Say you have a lot of oil stocks in your portfolio. Buying put options on Brent crude, for example, could help you balance out your risk. What would the strategy be called? Hedging. The above strategy is known as hedging. If oil falls, so will your oil-related shares, but the put option would increase in value. Scalping refers to when you try to profit over small price changes in the market. Diversification, on the other hand, includes introducing various other stocks and markets into your portfolio. The methods we've outlined in this lesson aren't the only options available to you. The general idea is to structure your pyramid according to your own needs and risk profile. So, structure your pyramid to your own needs and risk profile. You can choose whichever low, medium or high risk solutions fit within your financial goals. So lesson summary, there are several ways to implement a multi-product strategy to achieve your financial goals. The products you choose to include may depend on your risk profile, time horizons and personal understanding of how they work. So the products you choose to include in your portfolio may depend on your risk profile, time horizons and personal understanding of how they work. You could choose to stick to investing, trading or a combination of the two. Visualizing your portfolio structure as a pyramid might help you build a stable base so that your entire strategy is less affected by major shifts in the market. Using options or ETPs, exchange traded products, means you can hedge other parts of your portfolio and offset potential losses. So using options and exchange traded products means you can hedge other parts of your portfolio and offset potential losses. Oh, and I just realised options means you don't have to oblige to take the option, right? So if the market does go in your favour and you do have a put option, you don't have to take it, right? Because you don't have the obligation to. So, oh, I see why they mention options now, right? So it's just there as a backup, just in case the market doesn't go in your favour and goes against you. You have the option to take that to offset your losses. But if the market does go in favour of you, you don't have to take the option. Ah, okay, I see. I think that's how it works. Right. Alright. I'm going to leave this episode here. So, in the next video, we're going to start off with the quiz, which summarizes everything in this, what's this lesson called? How to choose the right product. So, thank you all for watching, and I will see you guys in the next video. Bye bye.